Real estate is one of the most popular ways people build long-term wealth, but it's also one of the most misunderstood. In this video, we're breaking down how real estate investing works, the benefits, the risks, what to look for when buying property, and the big picture mindset you need before investing your first dollar. Let's start with the basics. Real estate investing means putting money into property with the goal of generating income, appreciation, or both. This can include residential homes, apartment buildings, commercial properties, or even real estate investment trusts. Most real estate investments fall into two categories: cash flow and appreciation. Cash flow comes from rental income after expenses like mortgages, taxes, and maintenance. Appreciation is the increase in a property's value over time. Many successful investors aim for both, but it's important to understand that not every property provides strong cash flow, and not every market guarantees appreciation. Now let's talk about the benefits of real estate investing. One of the biggest advantages is leverage. Unlike stocks, real estate allows you to control a large asset with relatively little upfront cash. By using financing, you can invest in a property worth hundreds of thousands of dollars with a much smaller down payment. Another benefit is consistent income. Rental properties can generate monthly cash flow, which many investors use to cover expenses, reinvest, or supplement their income. Real estate can also act as an inflation hedge. As inflation rises, rent prices and property values often increase, while fixed-rate mortgage payments stay the same. There are also tax advantages. Depending on your situation, real estate investors may benefit from deductions such as depreciation, mortgage interest, and operating expenses. But real estate is not risk-free. Let's talk about the risks involved. One major risk is market risk. Property values can decline, especially during economic downturns or in overheated markets. Another risk is cash flow risk. If a property sits vacant or expenses rise unexpectedly, your investment can quickly turn negative. Maintenance and repair costs are another factor many beginners underestimate. Roofs, plumbing, HVAC systems, and appliances all wear out over time and can be expensive to replace. There is also tenant risk. Late payments, property damage, and legal issues like evictions can impact both your income and your time. And finally, real estate is illiquid. Unlike stocks, you can't instantly sell a property if you need cash quickly. That's why planning and patience are critical. Now let's discuss what to look for when evaluating a real estate investment. Location is one of the most important factors. Strong job markets, population growth, and good schools often support long-term demand for housing. You should also analyze rental demand. Look at vacancy rates, average rents, and how quickly properties are being rented in the area. Next, understand the numbers. This includes the purchase price, expected rental income, operating expenses, property taxes, insurance, and potential financing costs. Many investors run conservative estimates to ensure a property still works, even if expenses rise or rents fall slightly. You should also factor in your time commitment. Some investors self-manage properties, while others hire property managers. Management fees reduce profits, but they can also reduce stress and free up your time. Another key consideration is your investment strategy. Some investors focus on long-term rentals, while others prefer short-term rentals or value-add properties that require renovations. Each strategy has different risk levels, time commitments, and potential returns. Now let's talk about the big picture mindset. Real estate is not a get-rich-quick strategy. Most wealth in real estate is built over time through consistent cash flow, loan paydown, and long-term appreciation. Successful investors focus on fundamentals, not hype. They plan for worst-case scenarios, maintain emergency reserves, and avoid over-leveraging. It's also important to diversify. While real estate can be a powerful wealth-building tool, it shouldn't always be your only investment. Many investors balance real estate with stocks, bonds, and other assets. Finally, education matters. Understanding financing, market cycles, tax rules, and local regulations can significantly reduce risk and improve decision-making. Real estate rewards patience, discipline, and long-term thinking. When done responsibly, it can be a powerful tool for building financial stability and wealth.